In this video, I'm going to be talking about different types of cost averaging strategies that can be applied to Raindex. So far, we've experimented and rolled out into production in various contexts 3 higher level different types of cost averaging. So the basic idea of a cost averaging strategy is when you have one token and you want to convert it into another token, but you don't want to swap it instantaneously. So you want to convert the token over the course of some period of time. And usually you would do this because you are unsure of the market conditions, which is pretty common. So say you were looking at the market on a particular day and you wanted to convert 2 tokens from one to the other, and you saw that the market had a sudden spike or dip in the price. You might look at that and think, okay, this is where the market is now, and so I'm happy to do the swap. Or you might think that this is potentially a temporary change in the price, and so you might be worried that you're not going to get a good price because the market is going to move somewhere else, potentially against you, or potentially even if you had simply swapped today, there might be an opportunity coming next week or next month, and you aren't sure that today's price is going to be the best price. So a very common strategy to mitigate any short-term discrepancies in the market is to spread out the conversion process over a longer period of time. You won't benefit from any extreme price movements, like buying the absolute bottom of some dip, but you also won't suffer from any extreme price movements that are against you, like buying the top of some short-term price move up that then moves back down again later, and you realize later that you actually got a bad deal for that swap. So by averaging the swap process over many individual swaps, you end up with an average effective price according to the size of all of those trades. So you will probably end up buying some, or swapping, you would end up swapping some swaps for a bad price, and you'll do some swaps for a better price, and a lot of swaps in the middle somewhere, and overall it should cancel out to give you the average. So somewhere in the middle, and that price is less risky than trying to do an individual swap at any point in time overall. This is different from, say, a savings plan where you might be, say, receiving your salary in some stables, for example, if you work in the industry, and you're buying some other token periodically because you're getting periodic payments, and you're still doing individual, you end up with the same overall effect over a long term, but you're still doing each of those swaps as a specific swap. And the reason you're doing that is because you're basically lining up your trading activity with your revenue, your income, your salary, or whatever, which is fine and normal. But this averaging strategy as a strategy is less about when you get the money, and it's more about risk mitigation. That's the goal. So even though the end result is similar or the same, the goal is a little bit different, because you may have all of the token that you want to swap already, but you're deliberately spreading these swaps out over a period of time. You're not waiting for the token to come in so that you can swap it. You already probably have the token, or it could be both. Maybe you have some of the token now and you've got some of the token later, and you're depositing it into a vault over time on Raindex, which is possible. You don't have to deposit all the funds up front into a Rain strategy. It can manage it over a period of time. So the the goal here is really to smooth out prices, to risk mitigate, so you don't get any extreme benefits and you get no extreme negatives. You just get something somewhere in between. Now, this video is about the 3 broad ways that we've worked with so far. It's not saying this is all of the ways that you can do it, but this is what we've worked with so far. And they all have pros and cons. So the first would be a Oracle-based approach. So when you have a Oracle on chain, which just means some source of price data. Okay, so an Oracle is any source of information that it's not coming from you, it's not calculated from the blockchain, it's not it's not data that you can read directly, so you are trusting it somehow. So for example, a Oracle could be a Uniswap pool, okay? So you might say, well, that is on-chain data, so it's not an Oracle, but because Uniswap itself is a market-making strategy at its core, in its calculations of how it provides prices, it is possible for people to manipulate those prices. They can do things like flash loans and change the price within a single transaction, and then you could be reading that. So it's not, it can be manipulated. It's the information that you're reading from that source, if it's a Uniswap pool, is something that people still have some degree of control over. It's not entirely objective and uncorruptible. And the same can be said of other oracles. Every oracle is providing data to you, and there is some trust model, and that's not necessarily a bad thing. Choosing to trust things often brings a lot of benefits, like convenience, speed, maybe even things that would be impossible otherwise. But you do have to understand that you are choosing to trust something. So understanding what it is that you trust and why you trust it or don't trust it is most of the decision making around oracles, is really understanding why that oracle, you can use that safely for whatever it is that you're doing. The next approach would be a auction-based approach. So this would be, you don't know the price, so you're going to create an auction. So you start at some price that you think is extreme and too large. So you're asking too much for your token, and then you wind it down periodically. And then at some point, somebody would take the other side of that trade, because your price that you're asking is a reasonable price and someone's willing to pay that. And you can run as many auctions as you want. So this is much more resistant to manipulation than an oracle. But it also takes time, okay, to run the auction. So an oracle will give you an instantaneous price, whereas an auction has to actually run the auction. There's no way to do an instantaneous auction. You actually need to give external participants time to react. And then the third would be a tranche or grid style approach. So this is similar to the auction, but it sort of works in the opposite direction. You set up a preset or pre-calculated list of prices. Say every 1%, you're going to offer 1,000 tokens or whatever it is, or 1 token per 0.5% or something. There's some algorithm that sets up a grid or list of tranches or batches of tokens that you're going to be buying or selling. And basically, as the market moves, it's just going to intersect with those preset price points, and then someone is going to take it. It would be like if you went onto a traditional exchange and you just put up a list of limit orders manually. As the market moves, it's going to clear out those limit orders. Now on Raindex, because it's programmed, you don't have to manually create a list of limit orders. You can just have an algorithm that calculates all the limit orders up to infinity if you want. And the way that we've done it is that also the tranches recharge over time according to a budget. So again, the simplest way to think about it is that after some of those limit orders get used up, after a period of time, say a day or a few days, the strategy will start putting some of those limit orders back up so they can be taken again once the market reaches those prices again. So these are the three high-level ways that we have done cost averaging strategies. So we can drill down a little bit more into the pros and cons here. So let's make this a little bit smaller. So I just made the text larger. So when you're working with an Oracle, the main pro is that it is quick and easy, right? When you hook up to an Oracle, it's usually going to be about one line of Rainlang code in the strategy writing, because the actual words that are implemented in Rainlang will have handled a lot of the complexity for you, typically. So in Solidity, it might be dozens or hundreds of lines of code to do unit conversions, check that the Oracle is up and running, that the prices that it's giving you are not stale because they may have paused for some reason, etc., etc. But that typically you don't have to worry about by the time it gets to the Rainlang, because there will be a word that handles all of that under the hood. So from the perspective of writing a cost averaging strategy, it's conceptually very simple. Basically, you get the Oracle price, and then in your strategy, you say, I'm going to buy or sell this much of my token for the Oracle price. You just match the Oracle price, and perhaps you go a little bit below the Oracle price, because if you ask for a worse deal than what the Oracle is saying, it's more likely that someone is going to take the other side of that. So you might sweeten the deal a little bit by offering 0.5%, 1%, 0.1% below the Oracle, just to make it a bit easier for the trade to actually clear in that moment. And then you set up a daily budget or hourly budget or whatever it is, and you're just going to match the Oracle price. So this is really easy to implement. It's also predictable. You know that your strategy is just going to do whatever the Oracle says. So it's efficient as well. You know that there's not going to be large discrepancies between whatever Oracle is saying and what the market is saying, as long as the Oracle is high quality, right? That's the whole point of the Oracle. So you're never going to run into a situation where, because of the way that your strategy is set up, it overshoots or undershoots the market, which the other strategies can do, and I'll get to that in a minute. But typically, the Oracle, under normal good conditions, is going to provide the most predictable and accurate and efficient price, because that's literally the job of the Oracle. So the cons, though, is that you do actually need to have a high quality Oracle, right? So Oracles can be bad quality, and needing to understand what makes an Oracle good or bad is probably something that is underappreciated. Like I would say most people don't really think about that on a day-to-day basis. It's not a thing that people spend a lot of time, a lot of headspace on typically. Is this Uniswap pool that I'm looking at easy to manipulate? That's not a thing that people are often thinking about. They just take it for granted, but you can't really take it for granted actually if it's a Uniswap pool, because like I said before, someone could take out a flash loan, they could move the price, and then if you're just taking the price from the Oracle and then feeding it straight back into the market, they can basically manipulate your strategy into saying whatever price they want your strategy to be, which could be quite bad. So a good quality Oracle is going to be difficult to manipulate. And there are oracles like that out there, actually. Shout out to Flare, which is a chain that has oracles in the network itself. So the trust model there is that if you trust the chain, you should also be able to trust the oracles, at least to the point of them not deliberately trying to attack your trading strategy, right? So not all oracles are equal. They all have their own trust assumptions, and there's always a situation in which the oracle might lie. It could just be a bug, right? There could just be a bug in the oracle that causes it to give the wrong values. But typically, this is something that has to be considered because the oracle has its own reasons for giving the correct or incorrect data that have nothing to do with your trading strategy. So there's just an extra variable in the mix here. So that's probably the main con of the oracle. The other thing is there may not be an integration. It might not exist in a form that you can access it. Okay, so if you have some token that was just minted by some new project and they've just launched a week ago, there may not be a good quality oracle for that token. So a large pair like Ethereum and USDC, there's lots of oracles for that. Okay, not even necessarily USDC, just USD. There's lots of oracles for the price of Ethereum. There's lots of oracles for the price of Bitcoin. So this isn't a problem for that. But for a very large number of smaller, more niche tokens, finding a good quality oracle just may be impossible. It might not be there, especially if it's on a new network. Maybe like L2s are still relatively new. There's a few large L2s, but a lot of L2s are still pretty new and getting off the ground. There's new L1s obviously as well. So if you're in a less established environment, whether that's the token or the network or both, this may actually be impossible. So you may be forced to consider an alternate approach because there just isn't a good quality oracle that exists. So we can look at the auction next. So this is still, I would say, relatively conceptually simple. Right? It's maybe not as easy to implement as a one-line oracle in the Rainlink, but if you're using auction code that's been already written by somebody else and you're just adapting that, or you're just using it straight from the Rain GUI, the web app, you don't have to implement it anyway. So it being conceptually simple is a really good thing. Understanding what is happening is always a good thing, right? So the concept is quite simple. I explained it before. Basically, the price starts high and then it slowly gets lower. Okay, and at some point, someone is going to take the other side of that trade. So I can explain that in 2 sentences. So that is definitely a pro of this, because usually things that are simple to explain and understand are also easier to think about in terms of whether it's going to be secure and actually work. Okay, so the auction model doesn't have the cons of the Oracle model where you have to worry about trusting something, because all you're doing is offering a price and somebody can take that price at any point. Okay, so there's no third-party data involved. There's nothing that anybody can manipulate, because you are in complete control at all times, or the strategy is at all times in control of the prices that it is offering. It can't be manipulated or misunderstood, or somehow things go wrong for complicated reasons that maybe seem simple in hindsight but are difficult to predict upfront. So this is actually a really important point, that it's simple to run an option. It's not as predictable as Oracle's, but because you don't know when someone's going to take the other side of it, but it's still relatively predictable and efficient, but it's not as good as the Oracle, because the market can overshoot, actually. So I'll actually add that as a con. If you're running an auction and you run it too fast, you do run the risk that you are changing prices so quickly that nobody could respond in time. Okay, and when I say nobody, I'm including largely even arbitrage bots that are constantly scanning the markets and looking for basically opportunities that they can take because they see price mismatches, and they can do trades and all this and the other. For an auction, a lot of the time, the counterparty is not going to be a human being watching the auction and then clicking it when they feel like the price is a good price. It's going to be a bot that is watching the auction and sees that suddenly, within a second or a few seconds or a split second, that auction has provided a slightly better price than Uniswap or something, and is actually jumping on that trade as soon as it exists. So if you make the auction too fast, then even a bot can't respond to that in time. Think of it as an extreme example. If you ran an entire auction where you went from some very high price down to some very low price in 3 seconds, well, I mean, maybe nobody even was aware that the auction happened. It finished so fast. And if somebody did see it, by the time they saw it, the auction's probably at a very low and bad price. So that's great for the bot, and it's not very good for the owner of the strategy. So you can overshoot the market. And also, associated with that, you need to take time, right? So the auction can't be an instantaneous process, but in the context of a cost averaging strategy, that is much less of a problem than running an auction in other contexts might be, right? If your goal is to buy or sell some token over a month or 3 months or a week or something like that, then running a daily or hourly auction should not matter to you. It doesn't matter that you've run the auction hourly if you've been doing that every hour for a whole month, right? That time that the auction is taking is so much smaller than the total time of the strategy existing, that any issues that might have been caused by having to wait for the auction to complete should be smoothed out by the strategy itself, right? So for this purpose, auctions are generally actually pretty good, because their main weakness is generally mitigated by what you're trying to achieve anyway. It is a weakness, but it's not a weakness that impacts this particular type of strategy, which is cost averaging. So then the last one that we can look at is the tranche grid. So this one is also, it's predictable in the sense that you know all of the tranches up front. So you know the exact prices that you're offering because that's what the tranche does. It puts limit orders up. So if it's doing every percent above 100 for a sell, so it's going to sell at $100 and then $101 and then 1% more than that, 102.1 or 2 or whatever it is, it's going to add that percent every single time to the grid, to the limit orders. You know all of the price points ahead of time. So it's perfectly predictable in that sense. But unfortunately, the grid is typically not very efficient, actually. So its cons is that it is not efficient. And the reason for this is that there is a gap between each price that it is offering. So while the Oracle is offering a specific price, and the auction is offering a range of prices, like a smooth range of prices, which is going to be as accurate as the strategy can be, while changing a price over time, which, like I said, can overshoot if it's going really fast, but if it's going slow enough, then it is offering fine-grained prices because it's moving very slowly, so it actually has time to find an accurate price. The tranches have gaps, right? So if you set up a tranche every 1%, okay, then if the price is somewhere between those tranches, then you're leaving some money on the table, in the sense that, okay, you asked for $101 when you were selling that token, and the external market was willing to buy it for $101.50. So you don't get that 50 cents. If you set the tranche at, or the grid limit order, whatever you want to call it, if you set that at $101, you get exactly $101. So the predictability, which is a pro, can also be looked at as a con in that there are gaps between the tranches, and so it's not necessarily as efficient, I'll say, at capturing the exact market rate. So I'll expand on that. So the benefit of the tranche is also the downside of the tranche. It's a double-sided sword here. You know exactly what you're going to get, but you're never going to get better than what you're going to get. You're going to get exactly what you asked for, and the tranches will clear out. The other thing is that this can have gaps in coverage. So you can have, what I mean by that is time gaps. So it has price gaps and it also has time gaps. Because as the limit orders are being taken, so say it was selling at 100 and then 101 and then 102 from this example, let's say the market dropped again and it went back down to $100.05, until the market either comes back up again or until those limit orders get replaced by the strategy to come back to where the market is, nothing's happening. Okay, so you're not getting a true average price while the strategy is essentially paused because the market has moved into a range where the tranches have already been consumed. All those limit orders have been already consumed. So you have to wait for the market to come back, or you have to wait for the strategy to recharge itself and start intersecting the market again so that trades start happening. So you lose gaps in both space, like in the price, and you also have gaps in time in terms of when the market is outside the tranches and everything has to recalibrate. So it's not a true average. So it's good in some ways in that it's all set up ahead of time and perfectly predictable, but then that leads to, like, the market doesn't have to do exactly what you tell it to. It's going to move up and down on its own, and there are going to be gaps in the coverage. So if you really want a true cost average and you want to be getting prices all of the time and you want to be getting that real average, I would say stick to these ones. Okay, either an Oracle or an auction-based cost averaging approach. The tranche strategy can work just fine, but because it has the gaps, the quality of it as an average is probably not as good. So this approach where you pre-calculate a set of prices is totally reasonable in other contexts for other reasons, because you might want a strategy that is specifically buying at certain points and then selling at certain points, and you know that that's what you want. That's totally valid. But for cost averaging, I would say stick with either an Oracle-based approach or an auction-based approach. Okay, so high level, this is how they all work. I'm not going to go into implementation details on this video. There will be other videos that go more of a deep dive into how this is all actually achieved, how you can configure it for various strategies. But this is the first step, which is making a decision or understanding the decision being made or the implications of the different approaches to cost averaging. Yeah, so that's it for this video.